Welcome everyone to ERISA Fiduciary Governance, Part 4 of 4, Fiduciary Obligations for Fully Insured and Self-Insured Plans. Thank you all so much for joining us. The Benefits Compliance team will be answering the questions you send through the Q&A today. We'll try our best to answer all of your questions, but if for whatever reason we're unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We will be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you'll receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At this time, I'll hand it over to Chase Cannon, Senior Vice President and Deputy Chief Compliance Officer at NFP, and also Carol Wood, Vice President and Counsel of NFP Benefits Compliance. Chase, the floor is yours.
Thanks so much, Amber. Thanks everybody for joining the call today. This is exciting. We are on part 4 of our ERISA fiduciary obligation call series, and we're really excited that you guys are sticking around and everybody that's joined is still with us through part 4 here. It's a lot to take in. It's a big assignment and project and obligation that you have as a sponsor of your plan. And so hopefully these webinars have been helpful. And hopefully they're starting to feel okay about the whole thing. So today we're going to focus heavily on the differences between fully insured and self-insured plans, looking at some very specific laws to follow under the wider umbrella of your ERISA fiduciary obligation to follow all the benefits compliance laws that you have to with respect to your plan. And so we'll be walking through those. And again, with each of those laws, we're going to be reviewing this through the lens of your fiduciary obligations and the differences and the extra focus for the most part that you're going to have if you sponsor a self-insured plan. Again, we've covered this on prior webinars, but when you have a self-insured plan, everything goes up as far as responsibility and heightened awareness and the number of items that you have to track and follow. Everything just gets amplified in that self-insured space. So let's jump right in, I guess, first of all, and I'm trying to figure out how to change our slides. Here we go. So in case you have forgotten what Carol and I look like, here's a beautiful picture of both of us. And we've kind of been your hosts on the 4-part series with our fiduciary governance here. So there's that. As usual, we have kind of a disclaimer. This webinar is really intended to be used for general guidance purposes only, not intended to constitute tax or legal advice, and really remember to engage your own legal or tax counsel if you have specific questions or wonder about specific application of the things we're talking about. And then our information is current as of today, September 17th, 2025. So with that, let's look at our agenda. Quite a bit to get through, but I promise this won't be as heavy as it looks. And we've got some great resources and takeaways at the end. And so try and just listen. You don't have to memorize all this. We will make the slides available afterwards and the recording afterwards. But you can see we have kind of 5 or 6 different laws and then some subcategories underneath those laws. And so we're going to be talking first of all, sort of the differences and the reasons why you might be fully insured versus self-insured. And then we'll dig into fiduciary duties and plan assets, preemption and coverage mandates, and then claims procedures, reporting and disclosures. All of those kind of fall under the broader umbrella of ERISA, which is the primary law we're talking about when we talk about fiduciary duties. And then we'll jump into some other laws where following the law is really important, and the requirements that you have to follow vary a little bit from self and to fully insured under COBRA, HIPAA, ACA, non-discrimination, and transparency. And then we'll get to those resources. So quite a bit to get through, but we're excited about this. I'm going to flip it over to Carol right away to talk about, this overview. What are we really talking about, and what are some of the important distinctions when it comes to just fully insured versus self-insured generally? Carol?
Okay, thank you, Chase, and good afternoon, everybody. Thank you for joining us. Yeah, in this first section, as Chase said, we want to do an overview and also define some of the terms that we're using. So what does it mean to be fully insured versus self-insured? Of course, we know with fully insured plans, the employer is contracting and paying the premium to the insurer, and the insurer is assuming the financial obligations for all plan claims and administrative costs. With self-insured plans, the employer assumes responsibility for all financial risks of plan claims and costs. So this is really the big distinction. That risk, that financial risk, is not transferred to a third party, although stop loss coverage can reduce some of the employer's risk. Now, a level funded plan is a hybrid solution. The employer is paying a set monthly amount to the insurer to cover estimated claims, the stop loss premium, and plan administrative costs. And of course, are lower than expected. They may receive some type of a surplus refund. But for compliance purposes, level funded plans are generally considered self-insured plans. Unfortunately, I mean, to be honest, we don't have really clear guidance from regulators regarding level funded plans. They do have their nuances. So generally, we're just going to look at them, though, as self-insured plans.
Yeah, and that's a big deal, right, Carol? I mean, we get a lot of questions on level funded. What does that mean? And a lot of people are unaware that that could be treated as a self-insured plan. So great clarification there.
Important to know. What is stop loss insurance? Well, for self-insured plans, stop loss coverage is normally designed to protect the sponsor against higher than expected claims experience. Under the stop loss policy, the insurer agrees to reimburse the employer for individual or aggregate claims paid in excess of a specified amount, the attachment point. A specific point would provide protection from large dollar claims incurred by a covered individual, and an aggregate one provides protection from high claims across all participants and beneficiaries. Stop loss policies vary widely. I think an hour presentation could be done on stop loss coverage, but it's important, therefore, that sponsors should ensure they contract carefully and understand the policy details, the coverage period, the application, does it apply to claims incurred and paid, to avoid any gaps. And this type of coverage is very important in managing financial risk for many employers, but the stop loss carrier doesn't have any obligation to pay the claims of plan participants. So the risk really remains with the sponsor of that self-insured plan. One of the potential advantages of self-insured plans over fully insured ones, well, a big one is that the coverage can be customized to the employer's goals and their population. The plan is not subject, as we'll be discussing, to state insurance laws and mandates. And this is ERISA plans, governmental plans, of course, maybe, and MEWA's multiple employer welfare arrangements are subject to state insurance laws. The employer has control over more control, selecting, monitoring, and coordinating service providers. The employer may be able to retain funds if health claims are lower than expected, and potential cost savings also, because unlike insured coverage, there's no profit or risk margins that are being paid to the carrier or state premium taxes. What are potential disadvantages of self-insured plans over fully insured plans? The employer is exposed to financial risk of loss due to unexpectedly high claims. That's really the big one. And these costs and expenses can be unpredictable. The plan typically requires greater involvement by the employer from internally, their internal teams, HR, finance, legal, risk management, etc., and also from external service providers, TPAs, actuaries, consultants, lawyers. The big distinction, though, the one that we're going to be focusing on today, is that the employer has increased fiduciary and compliance obligations because these obligations are no longer shared with the carrier. The employer is ultimately responsible for compliance, even if they receive assistance from a TPA or ASO. And it's really important to understand these obligations, primarily to run your plan well, but also to avoid any penalties or lawsuits that could result from errors or oversights. Okay, now I want to move to fiduciary duties and plan assets, and this has got to warn you, it's kind of a tough topic, but just bear with us. It's a short segment, just 2 slides. Okay, how does the plan funding process differ for a self-insured versus fully insured plan? And the main distinction here in the process is that a self-insured plan has to project plan costs, where a fully insured plan's costs are set by the carrier's premium rate. Otherwise, both self-insured and fully insured plans have to determine the funding method and the payment mechanism. And the sponsor has flexibility, but the choice can impact their compliance obligations. So for the self-insured plan, they're going to have to project what those costs are. Actuaries would be involved with that process. And the projections are normally based on past costs and assumptions about future obligations. This allows sponsors to plan financially, set participant cost sharing, and understand their financial exposure. Of course, actual costs may differ, and that's where the stop loss coverage comes in to protect against unlimited cost risk. Um, Determining the funding method, there are three main funding methods. Benefits can be paid from the employer's general assets, and this is what we call an unfunded plan. And we're trying to reserve the use of the word funded. We're trying not to say self-funded when we mean self-insured, and reserve funded to mean, are the benefits being paid from the employer's general assets, an unfunded plan, or are being paid from separate funds that are maintained a separate account exclusively for purposes of the plan, such as a trust. And then typically also there are contributions made from plan participants and beneficiaries. Now, we know that the vast majority of employers funds fund their benefits through general assets and not through a trust. And we'll explain that a little more in detail on the next slide, and what the rules are. For both types of plans, we know that certain fiduciary duties attached to plan assets, and plan assets include participant contributions to premiums, amounts attributable to plan assets, such as rebates, an MLR rebate season, that's a good example, and also funds held in separate accounts or trusts to pay plan benefits. And ERISA, the general rule is actually that all plan assets have to be held in a trust. And of course, for those of us who have worked on the retirement side, we know this is always the case, right? There's always going to be a trust to hold those plan assets. But on the group health plan side, the DOL doesn't enforce this requirement for these participant premium contributions. But there are certain rules that the employer has to follow. They have to make sure that they timely forward the premium payments to the carrier once they're withheld from employees' pay. That's for an insured plan, or use the amounts to pay plan benefits for a self-insured plan. And additionally, the amounts have to be paid from the employer's general assets and not maintained in a separate plan account. So employers need to be careful. You don't want to set up an account in the plan name. Be careful also with conduit accounts. There's in-between accounts where money isn't going directly from the employer's general assets. So a sponsor of both types of plans will always have to determine if the benefits are going to be paid from general assets, that unfunded plan, or in that separate account or trust, a funded plan. And when an employer is switching from a fully insured plan to self-insuring, it's probably a good time to revisit that decision. In some cases, a trust may be required. It could be under a collective bargaining agreement, but it can also be chosen for accounting, tax, or legal reasons. And one legal reason is that the funds are protected from creditors normally when they're held in a trust. Of course, counsel or a tax advisor should always be consulted for guidance. If an employer does go the trust route, and it's usually a self-insured employer that does, but again, it's probably the exception rather than the rule in most cases. There are significant compliance obligations that attach, and that would include trust document, appointment of trustees who are fiduciaries, a fidelity bond to protect against fraud, Form 5500, that's regardless of the plan size, and also an accountant's opinion of the plan's finances.
Yeah, so so a lot to consider there, Carol. This is super helpful to kind of walk through the different funding methods for a self-insured plan and reasons why you might go one route or the other, right? Like in some instances, it may make a lot of sense to establish a trust. There's some tax advantages that can come along with formation of certain trusts. Obviously, you need attorney help to do some of this, but there may be good reasons for that. But being aware of that, the consequences of that decision, right? You're going to have these additional compliance obligations. You're going to be considered funded, and that's going to change a little bit of what your compliance profile looks like.
Right. And
But
either way, I mean, we do want to emphasize that, and we spoke about this in the earlier sessions, that, it's that duty of loyalty and exclusive benefit rule that attaches, right? As soon as you have those plan assets, they really need to be used for the exclusive benefit of the plan and participants. And, employers really need to take great care, whichever way they go in the funding decision.
right, right. Being aware of that and making the right decisions once you move forward. I'd say the vast majority of our clients probably pay out of their general assets, right? So they're considered self-insured but unfunded.
Correct.
But so we do see sometimes those trusts coming into play. And again, there might be really good reasons for that. So let's move into some of the differences when it comes to this concept of ERISA preemption and coverage mandates. Once we know ERISA is attached, there are some, I mean, ERISA is going to attach no matter what here to a group health plan, but we've kind of decided we're going to be self-insured, we're fully insured as a company. What does that mean for this thing called ERISA preemption?
Sure. And this is a big difference, right, between your fully insured plan and your self-insured plan. Um, State insurance coverage mandates, we know these apply to fully insured plans, but they don't apply to ERISA self-insured health plans. Again, except for MIWAs. And so as an example, a large fully insured plan that's situs in New York has to comply with the state's fertility benefit mandates, and there's specific requirements to cover in vitro fertilization, and reference to the applicable website there. But a self-insured plan is in New York is not going to be subject to these requirements, right? They don't have to comply with state insurance mandates. And why are the two types of plans treated differently? And generally it's because ERISA preempts, it supersedes state laws that relate to ERISA plans. So that means these laws can't be enforced against self-insured plans. And part of this was that goal of ERISA that an employer operating in different states didn't have to comply with various state laws and could have more uniform benefit administration. Now, I know we see that concept being tested with our state PBM laws and in many other areas. So it's definitely an area where you see a lot of litigation, unfortunately. But I think this is clear as far as the state insurance laws. They don't apply to self-insured plans. Um, and the exception to that rule is for fully insured plans. Um, they have to, of course, follow the regulations of the state insurance department and ERISA as well. So what coverage restrictions then do apply to a self-insured plan? Well, sponsors of self-insured plans have wide discretion in terms of plan design, including certain coverage limitations and exclusions. There are certain rules. First of all, just to receive tax-favored treatment, the expenses have to qualify as 213D medical expenses. And just following through with our example before of fertility treatments, it sounds simple. Yes, it has to cover medical expenses, but not all fertility treatments would qualify. Generally, the treatment has to be to cover a disease or medical condition, and there's certain parameters for what they're going to cover or not. Additionally, a self-insured plan has to select a state benchmark plan, and this identifies certain benefits that are covered as essential health benefits. The self-insured plan is not required to cover these essential health benefits like small groups and individual plans do. But if these are offered, the plan must follow the chosen state benchmark and can impose annual or lifetime dollar limits on those EHBs. Now, note that a stop loss carrier isn't subject to these requirements. So it's always important, if the employer, is covering an essential health benefit under the benchmark, and there aren't these limitations, are there limitations on the stop loss coverage? You'd always want to be coordinating with that stop loss carrier. The self-insured plan sponsor can select any state benchmark plan. So that plan sponsor in New York could go ahead and choose the Utah benchmark plan. And that actually is a very popular plan. I think employers find it has a lot of flexibility. So employers should know that they don't have to choose the plan in their state. And I think they should make that decision carefully. The decision should be documented. And of course, it has to be communicated to the TPA and ASO. And there's more information on the various state benchmarks at this CMS website.
Yeah, that's an important decision, right? And does come back, bringing you back to kind of that fiduciary governance. This is your the ability and the thought that goes into which state benchmark plan you're going to choose is something you need to think about based on your employee base, right? And the type of benefits you want to offer and those that might be most beneficial to participants. That doesn't mean you have to, you're limited by a certain state benchmark plan. As you said, you can really select any state benchmark plan, but just making a conscious decision which one, going through the analysis of which one is, what are the limitations on each of those, and kind of why you got to that conclusion is important for fiduciary purposes. Um, Carol, what other coverage requirements are we
Sure.
talking about here?
The federal benefit mandates still apply to self-insured plans, just like they do to fully insured plans. So they have to cover ACA preventive care services. This is screening, immunizations, et cetera. And there's a lot of focus on this now, right? Perhaps we'll see some changes in what's covered or not. I think that's an area to watch. But self-insured plans, just like fully insured plans, have to cover those, have to comply with mental health parity requirements. There's certain other coverage requirements. I won't go through all of them here. And then more recently, though, the patient protections include those under the Consolidated Appropriations Act. We know they had surprise billing, continuity of care, expanded coverage for, certain emergency services. So those would apply to your self-insured plans as well.
Yeah, great. Good to understand. And sometimes we get confused on what's state law and what's federal law, right? And so it's good to kind of see this up on the screen, understand which rules are really falling under what would be considered state law. Self-insured plan wouldn't have to cover those state rules that they do have to follow. And then, this list of kind of federal. So let's stick with the federal. We're going to go into ERISA a little bit more, the disclosures, reporting, and claim procedures, but basic things like plan documents, Form 5500, and then we can talk claims procedures. But how does that in what the funding self-insured versus full insured, how's that impacted
Sure, and
here?
I think we can go through this slide pretty quickly because the reality is this is with the requirement to have an ERISA plan document and to follow that document applies both to self-insured and fully insured group health plans. And that's regardless of size. I'm just emphasizing that because sometimes we get some questions that seem to, think the document applies where the Form 5500 does. You have to have a certain participant count. So just remember, regardless of size, we need that written plan document. And the main difference is that, the self-insured plan is going to normally have a more tailored one, right? They're not, subject to the restrictions of the carrier and what's offered under that policy. So they have a lot more flexibility. And of course, they just have to be clear that it clearly outlines their employee dependent eligibility requirements, the covered benefits, any limitations or exclusions, the governance procedures, and how plan assets will be handled. The employer always has to make sure that that document, their plan document, is consistent with the carrier policy for a fully insured plan, the stop loss carrier agreements for a self-insured plan, and of course, a wrap document can alleviate, some of the need for separate plan documents in many cases. Both types of plans have to provide that SPD. How does self-insuring impact the firm 5,500? Again, a lot of similarities here, right? Both fully insured and self-insured health plans. The 100 or more participants at the start of the plan year have to file the Form 5500. Small self-insured funded plans, any plan through a trust is going to have to file a Form 5500, regardless of the plan size. Um, the schedules will vary depending on whether the plan's fully insured or self-insured. Schedule A is completed for self-insured policies only, and Schedule C for self-insured funded plans. Self-insured plans that pay benefits from general assets are not required to distribute a summary annual report to participants that otherwise would be due very soon for July 31st Form 5500 filing. But the exception only applies, a colleague reminded just recently, that if all plan benefits are self-insured. So that may not always be the case if a wrap ERISA document is used. Now here I think we may have more of a difference in some cases. How does self-insuring impact claims procedures? Insurers serve as the claims fiduciary for fully insured plans and are responsible for claims adjudication on the first and second levels of internal appeals. If applicable, the insurer will engage an independent review organization for further external review of that appeal claim. Self-insured plan sponsors usually see discretion over claims review and adjudication to a TPA or ASO, but they can also choose to take part in an internal appeals level. And if they choose to do so, the plan documents would need to be updated accordingly. And sponsors that wish to participate in that process should understand that they're going to be held to the fiduciary standard of a prudent expert with respect to their decisions. Now let's take a look at what goes into making that decision a little more closely. Should a self-insured plan sponsor handle second level claim appeals? And in deciding whether to take a more hands-on role, the employer is going to have to make sure they have a prudent process in place to review claim appeals. I know we've been talking about having a prudent process since the beginning of this fiduciary series. It's really necessary here. The employer is going to have to strictly comply with all regulatory requirements, including timeframes and notices. Um, make sure they're interpreting the plan terms consistently and accurately, and not making exceptions. That's always a no-no. A full and fair review of the denied claim is required. Can't just rubber stamp the TPA's prior decision. And it's important to gather and analyze medical information and records. Really importantly, consultation with healthcare professionals may be necessary if the sponsor lacks medical expertise to effectively evaluate the claim, and the decision has to be carefully documented. So employers assuming a role in that process should also consider whether they want to establish an appeals committee to help facilitate a consistent and prudent decision-making process. There's a great article in Compliance Corner, one of our new observations articles, so kudos to that team on a self-insured employer's role in that appeals process.
Yeah, and that article's really good to kind of break this down into a little bit more bite-sized pieces, right? Like there's some great bullets on this slide for sure, but that article available at nfp.com under our insights page where we store Compliance Corner. If anybody's out there and wanting to look at it right away, the link will work when we send around the slides. But just kind of talking about it in basic terms, what does it mean to be a part of the appeals process? How do you do that? What are the important points to consider as you're doing it? So yeah, it can be a challenging thing, but also one that is helpful, and just understanding the basics on it is really helpful. So thanks, Carol. With that, we're going to move into our COBRA obligations. So for the most part, we've been in ERISA, which again is ERISA is what's driving all this, right? Our fiduciary duties and obligations are found under ERISA, and those are kind of an umbrella over all the other laws that need to be considered and followed. And so we just talked a lot about the other ERISA rules that need to be followed. Let's look a little bit at COBRA and the distinctions in COBRA administration for fully insured versus self-insured. And really, to set the baseline here, both fully insured and self-insured have this general parameter that a COBRA premium has a limit, right? When you're an active employee, for an employer, they can kind of decide what the cost share should be or the employee contribution should be towards coverage, usually. And under the employer mandate, there has to be a limit on that. Employees can only be charged so much, right, under the affordability rules, at least for larger employers. But once somebody goes on to COBRA, the employer doesn't have those requirements and can really charge employees or former employees, depending on the situation, the full cost of coverage, and they can add that 2% administration charge. So we often hear that 102%. That's where we're getting that. It's the full premium, and then plus that 2% administration charge. So usually for a fully insured plan, you really are just relying on the carrier rate, right? The applicable premium for COBRA is really just the monthly insurance premium paid to the insurer. So you just kind of rely on the carrier in the fully insured context. For a self-insured plan, though, calculating that COBRA applicable premium is a little bit more challenging, and there's kind of two routes you can take. One is a reasonable actuarial estimate of future costs. So get your actuaries involved. Um, you may be able to check with your TPA on both of these, but past costs adjusted for changes in a cost of living index, that would be the other method. So one's kind of looking forward actuarially, one's kind of looking back at past costs and making adjustments for cost of living. So just a little bit different in how you do that. Again, sometimes TPAs can help with this. If not, actuaries can help with this. But there is a difference there, and there is responsibility on the employer's plan sponsor to make sure those premiums are being calculated correctly and applied correctly. So that's an important distinction there. We wanted to include this note on HRAs because those can be particularly challenging. Usually the same type of analysis of past costs, but just to note that COBRA beneficiaries are generally entitled to any additional accruals for the coverage period. So just know that there's a little bit of additional stress and challenge when you're talking about HRAs. Some difficult or challenging parts or situations under COBRA where it makes a difference how you approach this fully versus self-insured. For both, though, to again level set when it comes to coordination and approaching different challenging situations, both the fully insured plan and self-insured plan would always want to coordinate with either the carrier or the stop loss carrier. So, and just generally speaking, we want to be on the same page always with either of those, with COBRA offering generally. We included some special situations here. One would be an extension of continuation benefits beyond what federal or state COBRA requires. So if you wanted to extend coverage beyond COBRA or to individuals who may not be required to be covered under COBRA, such as a domestic partner, usually for a fully insured plan, you're going to be restricted by what the carrier says, right? Self-insured context, you have a little bit more flexibility. You can go a little bit further in offering COBRA-like coverage to those not entitled to federal COBRA. Again, we're using that domestic partner example. But you're always going to want to make sure that you're on the same page with the stop loss carrier in that situation. So that's really important. For denials of coverage, that's another situation that we see as special. For example, you decide not to offer COBRA because of gross misconduct. That's technically allowed. You don't have to offer COBRA in that situation, but gross misconduct is a very high bar. We generally say, be very sure that you qualify that before you don't offer COBRA, but in either instance, making sure that you're on board and communicate directly and consistently with the carrier for fully insured plans and stop loss carrier for self-insured plans. Subsidizing COBRA. This is something that we see a lot of under severance agreements, and usually severance agreements are enhanced, augmented, or only available to those employees who were highly compensated, maybe executive or management type of employees. And so if you're going to subsidize COBRA, this raises an issue under what we call the Section 105 non-discrimination rules. We're going to go there deeper in just a sec. But if the subsidies are higher for those highly compensated individuals, that can be problematic. Generally speaking, Carol mentioned earlier with the claims appeals, making exceptions, treating people differently under a plan, especially when it's a protected class, obviously, somebody who's a high claimant or a disability, something like that, but also you're highly compensated. Anytime you're treating them differently or both ways, including or excluding benefits, or coverages or subsidies, that's going to create non-discrimination issues. So in this context, and we'll talk about this in more depth here in a sec, it's really this, you cannot favor your highly compensated employees. So we'll circle back on that. HIPAA is a huge deal, privacy and security requirements, and the list of items that you have to follow when you are self-insured. And when I say self-insured, again, we're talking about health FSAs, HRAs, level funded. This is a big deal for HIPAA here. So to begin with, HIPAA is the law that we all appreciate as employees. Our employers with our information can't just go out and start selling our information, and they've got to follow certain rules and safeguard our what we call protected health information. That's information that kind of ties an individual's name to a health status or condition or medical disease, something like that. So for a fully insured plan, we use this term hands off, and really that means you're not seeing anything except for enrollment or disenrollment information and de-identified what we call aggregated data. If you're seeing just that, you're going to be considered hands off. If you're seeing more than that, you're going to be considered hands on, even if you're fully insured, and you would essentially become what we would call a self-insured plan, and you would have those additional HIPAA obligations. For a hands-off, fully insured employer, the list is still there. There's still some things you need to do to check the box here under HIPAA. That includes limiting PHI access and running a risk analysis. This is really kind of with your internal IT team trying to make sure there's no holes in the system where PHI or anything else could inadvertently be exposed, and then confirming that you're not creating PHI, you're not receiving or transmitting PHI. Usually the carrier will communicate information to you, but it will be limited to that aggregated data or just simple enrollment, disenrollment information. But checking to make sure that's the case. Developing and maintaining HIPAA authorizations for employees that contact HR with questions. So making sure that you get that authorization from the employee that it's okay to discuss that issue. Another thing you could do here is just refer that individual to the carrier. Again, we're talking in the fully insured kind of hands-off context here. Educating workforce members is important, just so they understand at a high level what HIPAA is, what PHI is, and what they should and shouldn't be seeing. Documenting compliance through this limited scope general policy. This is really just pretty basic, but just having a policy that says you're not going to retaliate against employees who exercise HIPAA rights or asking employees to waive these rights. So we think that should be done through a very simple documentation process so that there's something formal there. Making aware to your employees that there's a notice of privacy practices. The privacy of practices, that notice will be sent by the carrier, but just awareness of where that is. And then BAAs, these are the business associates agreements for those that are helping the plan through some type of service arrangement. Remember that FSAs and HRAs are self-insured plans and they would require a BAA. So in the fully insured context, the carrier is generally going to handle the rest of the obligations. This looks like a hard list, but it's actually pretty simple, straightforward, not heavy. But if you become self-insured, and again, thinking about if you're right now considering whether to go from fully to self, this is a big deal. There's a list of about 8 things we're going to talk about really quickly here that you have to do. The biggest one is going to be this adoption of written privacy policies and procedures, providing the notice of privacy practices to participants. That becomes your responsibility. entering into business associate agreements with everybody who's associated with the plan, which could include TPAs, PBMs, insurance brokers, again, to the extent their services involve the use or receipt of PHI. You're going to have to designate a HIPAA privacy and security officer to oversee the plan's compliance efforts. And again, security policies and procedures have to be developed. Security and privacy, what's the difference there? Privacy is really what you can and can't do with the information. And security is really the safeguarding of that information in electronic form. So we kind of live in that world now. You've got to be able to work with your IT and tech teams to get the proper security policies and procedures in place. So much of this depends on what you're doing as an employer and what is your risk for your appetite for risk. If you have an employee base that is all on computers and always works through email and shares a lot of this information, your profile and the things that you're going to put in your security policies and procedures are going to be very different than an environment where maybe you have truck drivers or your warehouse employees and you're just not doing that much electronically. Most of us live in the electronic world, so the security policies and procedures are really, really important. And then we won't go through it, but if you do have a breach, it's the requirements to notify in the event of breach are much bigger and more onerous for a self-insured plan. Always have to notify the impacted individuals, but once you hit a certain level, you might have to tell HHS, meaning the federal government, and even the media in some instances. So just be aware of those. You don't have to really memorize any of this, but this is the added list that comes into play. And when we're talking about it from a fiduciary perspective, understanding those additional requirements, particularly with the security and privacy policies and procedures, getting in touch with the right people within your organization, which includes, again, the IT and tech teams. You'll probably need somebody from the C-suite in there to talk and be aware of this. Obviously, your HR and benefits people will need to be a part of that discussion, and maybe some others as well. So this is one where it really takes that heightened fiduciary challenge and responsibility to get the right people in the room to make the right decisions and get the right policies and procedures. And ultimately, it can go along with a lot of what you're trying to accomplish to try and protect, your privacy policies anyway for non-health related information. You don't want people breaking into your systems anyway. It's just really heightened here under HIPAA because we have additional rules that relate to that protected health information. So with that, I'm going to move into ACA implications. Again, this is a different law now. ACA, what's the difference here when it comes to reporting? We wanted to highlight quickly the P-Core fee. This is something that makes a difference. You have to pay an additional fee. Most employers who have a self-insured plan, and that includes an HRA in this context, you have to file a form, it's Form 720, with the IRS and pay that fee. This one's kind of oddly timed with this October 1st date during a year, and based on the end of the plan year, your rate might be different if the end of the plan year is before or after October 1st of a year. This one was also supposed to go away in 2019, and Congress brought it back for 10 more years. So we're doing this until 2029. For fully insured plans, no problem here. The insurer, the carrier is responsible for that. But really just if you're switching to self-insured, this is an added fee you're going to have to pay. If you're adding an HRA, that would be an additional fee you would have to pay. So don't forget the HRAs when you're in a fully insured arrangement. And then reporting, we all love the 1094, 1095C forms. Self-insured plans have this additional responsibility to report on covered individuals. And so in the self-insured plan context, you have to complete parts 1, 2, and 3 of Form 1095C. And that part 3 is really reporting on the covered individuals. If you're fully insured, you only have to complete parts 1 and 2 of Form 1095C. That's the employer mandate requirement. If you're under, less than 50 and you don't have that employer mandate, but you're self-insuring, you do have to report that minimum essential coverage. So you have an option to use Forms 1094 and 95B in that instance. And then a reminder that most of these filings need to be done electronically now. So those are some little differences on the ACA. I mentioned non-discrimination. I just want to highlight this again. This is a big difference between fully insured and self-insured plans. Fully insured plans, most employers allow their employees to pay premiums or contributions pre-tax via the employer's cafeteria or Section 125 plan. That means Section 125 non-discrimination testing is in play. Fully insured plans are not subject to Section 105 non-discrimination tests, though. Self-insured plans kind of have both of those in play, 125 and 105. What are those numbers and sections? That's really just the section of the Internal Revenue Code that gives you the tax advantages that you get from offering these plans. You don't have to pay, or employees don't have to pay uh, tax on the benefits received and can make some of these contributions pre-tax. But this is one of the strings attached to that is these non-discrimination rules that basically say you can't have a plan design that somehow favors highly compensated employees. So watch out for variances in contributions, benefits, eligibility, and waiting periods. That's really where, when you have those variances, is kind of what you need to watch out for. Two things, we're going to kind of look at 125 versus 105 really quickly, but both of them kind of allow that variance based on what we call a bona fide business class, which means you need some business justification for the variance that you're suggesting or the difference that you're suggesting. If you can make a business case for it, it's probably fine. Some of those business cases or classifications would be geographic region, occupation, job title, hourly versus salary position. If your positions are more based on the names of people or very specific, just names of people you like in the company, or it's based on management or supervisory roles, that's where you might run into trouble. And the reason is that the outcome of that variance cannot favor the highly compensated or key employees. We're focusing on HCE as our term here, highly comped employee. That's one difference between 125 and 105. Under 125, we have this 155,000 threshold. Kind of keep that in your head. If somebody's making more than 155,000, this goes up to 160,000 next year. That's a highly compensated employee. If they're an officer or a more than 5% owner, they could also be a highly comp. So really what we're looking for is your group or your difference, your classification, is it going to contain a high concentration of those HCEs or key employees? I have that definition here as well. That's where you're going to have some challenges. 105 is the same concept. It's just that the definition of HCE is different, and it's really focused on this top 25% of all employees looking at compensation. So those are really the things to look at. And again, these non-discrimination rules, that addition of Section 105 does restrict a little bit more what a self-insured plan can do, and at the very least adds an additional layer of consideration when you're talking about your benefits designs. Under both of those sets of rules, if you fail that, if you do have an arrangement that's somehow favoring your highly compensated, the result is really taxation to those highly compensated employees. We call that taxation on excess reimbursements here under 105. But the basic idea is you're going to have some difficult conversations with your highly comped employees. They're going to have a little bit of extra tax to pay. And again, all of this going back to what we're talking about with fiduciary governance. Why are we going through this? It's really just to focus you again on the importance of understanding the difference of how some of these rules, we just went through ACA, COBRA, we're going to go to transparency, understanding all of those and the heightened rules or obligations that you have when you go from fully to self-insured. So important to understand and to be able to apply as you're administering or overseeing somebody who's administering the plan. This last slide really is just a couple of steps to take. I'm not going to go through it, but it's just kind of for your takeaway on what you can do for self-insured under 105. What are the things to look for when it comes to these tests and figuring out to make sure that you're not favoring your highly compensated. So with that, I'm going to flip it back to Carol, who I think has the most challenging part of this presentation because it's about transparency obligations. Transparency is such a new concept, and not necessarily a new concept, but a new in how it applies, and is really challenging, mostly coming out of our most recent legislation in 2021. So, Carol, do you want to walk us through transparency, which is kind of our last section of law here?
Sure. Yes, I'd be happy to. And I love to talk transparency, but thanks for that great overview on so many laws. You cover a lot of ground there. I think HIPAA is an area where, employers, really appreciate the information. And the non-discrimination testing you just covered. We receive so many questions related to non-discrimination. It's just, employers are constantly looking to vary benefits, contributions, et cetera. So a lot of important stuff there. But yes, transparency is really a focus today. And how do these transparency laws affect the obligations of fully insured and self-insured plan sponsors? We have and when we say transparency laws, we're referring to the Transparency and Coverage Final Rule and the Consolidated Appropriations Act of 2021, which impose significant new and ongoing obligations on both fully insured and self-insured plans. And we know these laws were designed to enable plans and participants to have the information they need regarding healthcare pricing so they could make informed decisions regarding their plan benefits. There were some other goals too: prevent surprise billing, improve access to mental health benefits. Generally, there's an overall scheme here. Generally, a fully insured plan can contract with the carrier, who's also subject to almost all of these requirements to fulfill their obligations for the plan, and can even contractually assume liability for a compliance failure. In contrast, the self-insured plan can contract with the TPA to assist with fulfilling the requirements, but remains ultimately responsible for compliance. So that's really the big difference. I mean, in either way, you want to have a written contract, but regardless of that contract, as far as the federal regulators are concerned, with a self-insured plan, you're always going to be ultimately responsible for compliance. In both cases, significant interaction with the carrier or TPA is needed to ensure applicable deadlines and requirements are met. Next slide. Right, so what are the requirements am I talking about? Don't worry, I will not go through all of these, but you can see it's quite an extensive list, right? The transparency and coverage rule. We have our machine readable files. We're expecting guidance on the prescription drug file. That's never even been enforced, so that's we should get news on that hopefully soon. The Internet self-service tool for participants. We have the No Surprises Act to protect against surprise billing. And then the other title that's under the Consolidated Appropriations Act is transparency, which brings us our gag clause requirements, the mental health parity, non-quantitative, written analysis requirement, the service provider compensation disclosures. On that also, we're expecting guidance next month, really. Particularly relating to pharmacy benefit manager disclosures, and then also the RxDC reporting. So a lot of requirements, a lot of new obligations. Next slide. Why is transparency so important for group health plan sponsors? We know that they need to ensure as plan fiduciary that the assets are administered prudently and the sole interest of participants. They have to carefully select and monitor their service providers and verify that the service provider's compensation is reasonable. And they need access to the healthcare costs, claims data, service provider compensation in order to fulfill these obligations. And of course, it's particularly important. It's important for both fully insured and self-insured plans. But self-insured plans, again, are assuming greater discretionary authority, financial responsibility, and obligations with respect to the plan and plan assets. And we see the recent litigation targeting employers, self-insured plan sponsors for failing to fulfill these duties. The Trump administration also, I'd point out, has signaled that price transparency is a priority. We're expecting to see guidance. So where we have a largely deregulatory administration, Transparency is a focus, so employers really need to stay tuned. And key takeaways here, just really make sure employers that they're fulfilling the requirements, evaluating those service provider compensation disclosures, monitoring for guidance, and for litigation, and expect more laws in this area.
Yeah, it's such a quickly developing area, right? And also just a little bit of I kind of call it an awkward love triangle that is a result of these laws, like the employers being asked to do things, being asked to do access or post or share information that only the carrier or TPA has. And then we as the broker are trying to support on that, but don't always have, don't have the information either. And so it just becomes, it's a big challenge and it's a tough spot that the laws have put put employers, our audience on this call today, in under these transparency rules. But this is a
It's
great week.
true. It's
Yeah,
very true. And the regulators don't have direct enforcement over TPAs, right? So it's a lot of their enforcement
yeah,
efforts, the self-insured plan sponsor, even though the laws are really aimed at helping the plan sponsor.
right. And so much of this information can be really helpful when we're talking about the fiduciary obligation when it comes to controlling costs, getting better benefits, making things more easy to access. Price information is a big part of that. And so, yeah, a lot of this information can be really helpful as for employers in satisfying their fiduciary duties.
Yeah, hopefully
And
we'll see
making,
those lower prices, right? I'm not sure if a lot of employers are seeing those, but hopefully we'll
yeah,
get those. They're like, Carol, what do you mean? The goals are
yeah,
achieved, but hopefully we'll see some results over time.
yeah. Sometimes feels like the wizard behind the curtain, right? Like what is that thing called? Affordability or cheaper prices. Okay, so we are at the end of our time here basically, but we just had a couple more slides talking about some takeaways and then some NFP resources. So again, want to highlight a couple of points here. Both fully and self-insured plans really have fiduciary obligations, and but the transition from fully to self-insured, or if you're just already self-insured, you're going to have more stuff, right? Really, that's the bottom line. But you do have more design flexibility, potential financial advantages, but those fiduciary obligations go up. There's more to comply with. There's bigger considerations to follow. There's more chance of litigation and all of that. So understanding the financial risks, the compliance considerations in becoming full insured or becoming self-insured or becoming fully insured. Um, Re-highlighting, not on this slide, but health FSAs, HRAs, generally considered self-insured, right? And so you're gonna have those heightened obligations. You're likely to engage service providers to fulfill certain obligations. But remember, that's not the end of it. We've talked about this on past calls. Our last call, I think, was all about selecting and monitoring service providers. So the selection is one part, the monitoring is a different part, remembering that that's there. Service contracts sufficiently addressing ongoing benefits compliance obligations. That's an important part of that too, where you're engaging a service provider. Staying on top of this, we will do our best and have done our best and in covering developments. We'll include that in our Compliance Corner newsletter. If you're not getting that directly as an NFP client, we also post it on our nfp.com website. I mentioned that under our Insights tab there. So go check that out. That's a great way to follow what is changing. And then a reminder that we have from the start had this really helpful toolkit, and other publications that really go back to the basics on fiduciary governance, right? Over the course of our 4 webinars here, we've focused on different aspects of the fiduciary governance program and rules. And so taking it back to the beginning, we released this toolkit and publication. In the toolkit, we have a publication, we have some PowerPoint slides, we have kind of an overview and checklist. What you're looking at here on the slide with Appendix A is a checklist that you can follow when it comes to putting in your governance program, establishing documents and processes. So if you do not have this publication, reach out to your NFP contact and they can get it for you. We have additional publications on all of the stuff that we've talked about today. The HIPAA privacy and security, we're releasing that in the next couple weeks. But ERISA, ACA, COBRA, the non-discrimination, transparency, P-Core, all of this is so overwhelming, I know, but we have resources, publications that go through it step by step and can really help hold your hand through some of this stuff. So thank you so much for joining us. I'm going to flip it. And thank you, Carol. It's been a pleasure doing today's presentation and the whole webinar series with you. But thanks to our audience for tuning in. And I'm going to flip it back over to Amber to close us out.
All right. Thank you, Carol and Chase, for sharing your valuable time and expertise with us today. To reiterate, today's presentation was recorded. We'll be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you'll receive an email with a link to the full recording. The PowerPoint slides used in this presentation will be shared in the same email. At the end of this call, a survey will populate in a new window. Please take a brief moment to complete the survey, as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you, everyone, for joining us, and have a great day.